Okay, happy solstice. What is up? Happy quad witching Friday. Um, I'm going to quickly go over the credit spread. Hopefully, this should be fast. And if I can't do it in more than 10 minutes, I'll just come back to it and try again. Anyway, same notebook as before, but a copy. And I'll just show quickly in TradingView what this is. Here's the S&P 500. This is the credit spread FRED index. It's this big long code, BAMLH0A0HY something. And what this is it's the interest rate of corporate debt versus the interest rate of government debt, so risk-free. It's kind of showing how risky do people think corporations are, like investment grade corporate debt. So this number here is the difference between that. How far back does this go? It goes back to 97. So this is the dot-com boom. It was around 8. It went down in the before the GFC down to 2, or really 3. It way spiked up in 2008, 2009, and ever since then it's kind of been bouncing around between 8 in times of stress and 2 to 3 in times of complacency. And just in the recent history, here's 2020, here's 22, and here is Liberation Day. I'm going to just add another thing down here, and we can compare it to SPY. Hang on. Yeah, so it's right here, it's like inverse to SPY. We have a little dip here in the yen carry trade thing. We had a dip here, and another thing I would look at is just what was the actual interest rate at that time. Here's the interest rate. So here's when we began hiking. Come here. Damn it. Yeah, here's 20. It's not matching up. Okay. Here's 2022. Big financial, or not big financial crisis, COVID. The spreads start going up as we are hiking, and then here was higher for longer, and here was the yen carry trade blowout. Here was Liberation Day. Okay, so moving on, it's just the spread between two interest rates. Why is this useful? Oh yeah, I was going to compare it with the VIX time series as well. I'll just look at it with the VIX thing real quick. Where is it? This one. Boom. Actually, we'll put it on here. Damn it. Hey, now we can see something. Okay. S&P 500. So, yeah, here's 2020. Boom, they both moved together. they both clearly revert together, and we have bottom. Here the VIX probably had a rollover. Man, I can't have this. Get out of here. Yeah, so this is 0 on the VIX. We start our hiking cycle, and then the credit spread is moving up. Here it reverts. So here, these aren't matching up exactly, but you know, it's not really a buying opportunity exactly. It's kind of like a bear market short squeeze. Here it's coming down, and we have a as it's coming down, these were great buying opportunities in hindsight, but in the moment, how would you have known? In March here, there's Silicon Valley banking crisis, so that probably explains why the credit spread went up, but it really wasn't that much. Then it's coming in. Here, having a peak and then a reversion. This looks really good for a buying opportunity here. Again, they're not matching up. Okay, there they match up. And then where was the VIX? The VIX briefly touched 0 and then started coming in. So like here, both of these reverting at the same time, and then equities going up. This is like our ideal buy signal with also our hindsight. Here, yen carry trade blow up. Let's just zoom in on this stuff. Yen carry trade blow up. VIX and credit spread moves together, then it reverts. VIX reverts very cleanly. And it would be great if these could match, right? Here's them reverting. And then here we have, oh my god, this matching thing is really annoying. Here we have them both spike up on whatever day, Liberation Day, and then they're reverting, and so that's where we are now. Like, VIX got below 0 as of May 12th. And this credit spread, it started out at 2.5, went up to 7 or more, came back down below 5, back into 3. So I would say, hey, if it goes above 5 and comes back below 3, just in the history, that's kind of reasonable. That would have been here in COVID. That would have been here in this. I don't know what happened here, actually. Here it didn't quite get that high. 5, back down to 3. I don't know, that's pretty arbitrary, but yeah, I guess the beauty of these two things actually is that there aren't parameters to them. They're just real-time data. And the absolute levels do kind of mean something. I'll stop there, and then we'll get into the data and just see if we can quantify stuff. But real quickly, the last thing I would say is that sometimes you have the VIX blowing out and you don't have the credit spread blowing out at the same time. Here was the Volmageddon. Here, the volatility spikes and comes back down, but the credit spread barely does anything. Why? Because the volatility complex blowing up due to some ETF being over leveraged doesn't really affect like corporations in the United States, unless it was something like you know, great GFC level, like where it's like, hey, yeah, all the corporations, all the banks are invested in this ETF, and it's going to bring them down altogether. That wasn't going to happen here, so there's a minor movement in the credit spread. Then you have times when this credit spread is moving, like here, late 2018. This was like a 1/4 bear market, 1/4 bear market. I don't know what was happening here. I can't remember. Here, COVID, really obvious. It's the end of the world. And then here, you have the credit spread going up pretty slowly and systematically. It wasn't like a quick spike like here. But this is because the interest rates were rising, and it's kind of like into spring 23, it's kind of like, oh, that's actually affecting some of these regional banks. But you'll notice VIX is not really even above zero. It touches zero sometimes, which could give you minor little, you know, buy the dips, but you're really in a bear market at this point. And so, yeah, just thinking about how those go together and what the drivers of your specific situation are. We'll get to it more in another like short video.